Homeowners have very high levels of tappable equity today, providing a cushion to withstand potential price declines, but also preventing a housing distress turning into a foreclosure. So what they're basically saying there is if somebody has that equity, they can prevent foreclosure if they're ahead of the game. And it goes on. The result will likely be more of a trickle of foreclosures than a tsunami.
Good morning, Lab Coat Agents. My name is Shaniqua Badger. I am one of the moderators for Lab Coat Agents. It is good morning on the West Coast and it's good afternoon on the East Coast. So we're going to go ahead and give that salutation to everyone. Hope everyone is doing well on this. Let me look at my phone. I do believe it's a Friday. So we're at the start of our weekend. We have some really great information to bring to you today. And I'm really excited to hear what David has to give to us about what's going on in the industry, what's going on in the real estate market. Like, even though we're real estate agents, we still got to know, right? We still have questions. We still want to know what's going on. So I think this is a timely discussion, and I am going to officially yield the floor. David, the floor is yours.
Well, thank you for that introduction, Shaniqua. Excited to be on with you and spend a few minutes together talking about the market, and I think your point of, we need to know what's going on is very true. And there's a lot happening in the world of real estate. I think the things that come to mind for me right now, we're in a very, very fast moving market. And as always, I'm going to show a few slides and bring up a few topics, but it's important that we stay on top of it, because what may be true one week changes the next week, and very, very fast moving market that we need to stay on top of. So grateful for this time. Always enjoy this time that we get a chance to connect, and I know many that are on here regularly attend this, and the chat is open. I know we're live here on Zoom and on Facebook. So let us know where you're watching from. Let me know if there are questions that you have too. Happy to take those. As always, I always say, happy to take any question as long as I reserve the right to say I don't know. But love to have questions, and just grateful for everybody in this time and energy and this time and understanding what's going on in the market. So here's what I thought we would do today is talk about a few things. Probably the biggest thing happening in the market that I want to break down for you is interest rates. We've seen a little bit of relief on interest rates, and is that going to continue? I want to give you a perspective on that so that you can be equipped there. We'll talk a little bit about some of the challenges, some of the headlines that are out there relative to debt, relative to foreclosures, relative to prices dropping, so that you have perspective on those things, because I think these topics come up, and if we don't have an answer to be able to, in an articulate way, sort of have a relevant market opinion, as I always say, about this, then we're probably caught in a situation where, it may appear that we're not on top of it. So that's my goal, is to give you that. As always, so grateful for those that are KCM members. You can grab these slides. If you're a KCM member, you can always email me, David at Keeping Current Matters. Happy to get those slides to you as well. So, as always, I do bring some slides, and we'll talk about this as we get going. But maybe we'll start off with kind of a debt topic and what's going on with debt in this country, and ultimately, equity. And then I'm going to end maybe the last portion of what we do on interest rates, because I think it's critically important that we understand that and where we're heading in interest rates. So share my screen and we'll get rolling right away here. So if you can see my screen there, this is a headline. It's actually from Diana Olnick. Homeowners have lost 1.5 trillion in equity since May as home prices drop. We always say headlines like this do more to terrify clients than they do to clarify what is actually going on. And no doubt, if you're watching this, these are the types of things that we have people text us or email us and say, here, what do you think about this? What's going here? This sounds terrible. Homeowners have lost $1.5 trillion worth of equity since May. Could that, that doesn't sound good. What's going to happen with real estate? And, this seems to be problematic. And, I want to give you a little bit of perspective on that. That's what I always try to bring is perspective in the market. And, when you see a headline like this, I don't think it does an accurate job of really portraying what's happening in real estate. So let me break this down graphically for you. This is what this looks like right here. If you see where my cursor is at, tappable equity has dropped, but I want to put it into perspective. Now, let me back up. If you're not familiar with tappable equity, that's the amount available to a homeowner that they can access before hitting 80% LTV, loan to value. It's still way above where it was last year, $400 million above where it was last year in this country. But if you go back and you look at this, this goes all the way back to 2005. Tappable equity has grown in a dramatic way in this country, really over the last 10 years, but the last couple of years, significant growth in tappable equity. Now, if you think about tappable equity, that's where you can get to 80% LTV. If you have a $100,000 loan, that would be $80,000. What's the equity up until $80,000? It doesn't even count the last 20%. And what do you see? We're well above where we were certainly in 2019 or 2020, but has come down slightly. And so when somebody says something like this or sees a headline like that, they think, homes are losing value all over the country and we're in trouble. And no, that's not what's happening. I think our job today is to bring perspective to some of these headlines, some of the things that are floating around out there, so that we can help people make educated decisions. If we continue on this topic, so to speak, homeowners have very high levels of tappable equity today, providing a cushion to withstand potential price declines, but also preventing a housing distress turning into a foreclosure. So what they're basically saying there is if somebody has that equity, they can prevent foreclosure if they're ahead of the game. And it goes on. The result will likely be more and more of a trickle of foreclosures than a tsunami. Still a lot of people today thinking, what, as we go into this, we're going to see this flood of foreclosures. We're going to see them come to market. I'm going to wait and snap one up. And it's just not there. The primary reason is this tappable equity that we just talked about. If somebody's in trouble, they can put their home on the market and they have the ability to pay a commission and get through that transaction and probably put a little money in their pocket before anything, were to happen, a forced sale or be in a situation where they have to do something. They can choose to do that. And certainly our job is to be there and be ready to help serve someone if they're in that situation. So I think that's a key headline that I would expect to see out there, or expect to hear maybe from people on, and maybe having these slides, having your perspective on that will help to educate those that are concerned about that. I think the other thing that we're hearing a lot about in the news is household debt. And I'll grab another headline here. Household debt soars at the fastest pace in 15 years as credit card use surges, the Fed report says. And if you see here, a couple of key points: household increased debt at the fastest pace in 15 years due to hefty increases in credit card usage and mortgage balances. We know mortgage balances have gone up. We've talked about that extensively. If you follow Keeping Current Matters, you're well aware of that. They go on to say the second bullet here, if you see my little cursor, the credit card balance collectively rose more than 15% from the same period in 2021, the largest annual jump in more than 20 years, according to the New York Fed. Why is this important right here? Certainly from a headline perspective, we're hearing all about inflation. We know it. You go to the grocery store, you go anywhere else, things cost more, and we know that we're suffering under kind of the burden of inflation. But we also know that, listen, it's costing more for people to live, and that impacts those on the lower side of the earnings scale more than anyone else. And this makes sense. Household debt is rising, okay? And I think this is where some of maybe the fear mongers come out, like, hey, nobody's gonna be able to pay their bills and everybody's gonna have to sell their house or go into foreclosure and the market's gonna crash. That's where a lot of those lines of thinking come from. Well, again, I think we need to be educated on this. We need to understand what's going on. And so I want to break this down because it's very interesting what's happening in this country, because when you start to look at the facts, they're very different than what headlines say. So let's take this topic right here, because I'm going to talk about credit card balances and I'm going to talk about mortgage balances and the debt on mortgages in this country. First one, credit card balances. They're actually near 2019 levels. So what happened during the pandemic is you saw stimulus come into the market, and you saw savings rise for people, and you saw people lay off putting things on credit cards. And what are we doing? We've gotten through that, and we're coming to the other side of that, and people are starting to use their credit cards again. I'm not saying that life isn't more expensive, because it is, but it's not indicative of what that headline, I'm going to go back to it, tries to show you. If you look at this, while all of that is factually true, credit card balance is rising 15%, the biggest rise, we're back to really where we were in 2019 relative to that. So it's important to keep this in perspective, because if this sort of runs off the rails, people think, gosh, this is going to mean bad things for consumers, ultimately for housing. That's what we talk about. That's what we need to be concerned about. And where this kind of dovetails into is, okay, what if then people can't afford to pay their mortgage because they're paying more for food? They're putting everything on their credit card. Well, let's look real quick at the debt to income ratio in this country for mortgage balances. This is very, very important. This is the household debt service ratio for mortgage as a percentage of personal income. So this is the way the Fed measures mortgage debt. You think about, what are people earning? What do they have committed to their housing payment? And what do you see here? Kind of going through the 90s, 5-6%, we jumped up to over 7%, almost 7.25% of someone's income devoted to a mortgage nationally. And where are we at today? 3.9%. When you look at the greater economy and what people have committed, their required mortgage payment divided by their quarterly disposable income, it's lower than it's been going all the way back to the 80s. And so I think having an opinion on this is critically important today, because where this goes is this goes to a topic that people sort of chase that out and they get fearful. Decisions are increasingly being made out of fear today relative to real estate. Should I buy a home? What's going to happen in the market? Is it going to crash? What's going on? And I think we can do a good job, because this kind of dovetails into the foreclosure question. What's happening with foreclosure? It's very, very interesting. And I want to bring you the most up-to-date information on that as well before I kick into the interest rate conversation. Maybe I'll pause. If you have a question, certainly put that question in the chat here, but I'll pause for a second before we get into interest rates for that. But let's talk about delinquencies and foreclosures for just a second, kind of giving you this update of everything relative to debt. Maria Walsh from MBA said this: for the second quarter in a row, the mortgage delinquency rate, leading indicator for foreclosures, fell to its lowest level since MBA's survey began in 1979, declining to 3.45%. Foreclosure starts and loans in process of foreclosure also dropped in the third quarter to levels further below their historical averages. So when you look at delinquency rate, you don't see like this, this massive amount of delinquencies. It actually fell. When you look at starts, they've dropped as well in the third quarter. People have options today. They can sell their home. There's a term in pricing that I've talked about. It's called downside sticky, which means prices on a home will hold if somebody's not required to sell. What happened back in 2008 is people were required to sell their homes, and they were required to do that because there were no other options. There was a flood of inventory. They couldn't afford them. Maybe an adjustable rate mortgage adjusted, whatever the case was, and they were required to sell. Very, very different today. We know those products, one, aren't in the market. We know, two, people have qualified for their mortgages. We know equity is at a record high right now across the country. And so there's just not this case to me to be made relative to a massive amount of foreclosures. Here's the actual look It's the number of folks that have had new foreclosures in this country. So this goes all the way back to 2003. It's the number of consumers with new foreclosures. Think about that, a foreclosure starting. And the years in red, significant years during the housing crisis. And where are we at the first 3 quarters of this year? 88,000 foreclosures in this country. To put that into perspective, in 2019, there were 278,000 foreclosures in this country. So we will likely surpass 2020, absolutely surpass 2021. Oh, by the way, there was a moratorium on foreclosures in this country. So they will be up, and you should expect to hear those headlines coming up. Foreclosures higher than they've been in the last 2 years. Foreclosures up by X%, which sounds like 400% or whatever the number is. And bringing context to that for the clients that we serve, I think is critically important. The fact is, if you look at this right here in 2009, there's been a drop in foreclosures every year. So this will be a reverse in that trend, but there are a lot of very tangible and reasons that make sense why this is happening. That if people don't know that, they believe the headline, they kind of get freaked out. They're like, I'm not sure what I'm going to do. Everybody's about to get foreclosed on and the housing market's going to crash. Nowhere near that. But I think more than anything right now, we're fighting almost a misinformation campaign in the media about the housing market. So I want to pause for just a second. Any questions there? Anything come to mind? Did that make sense? Does that help you in understanding where we're at in the market? If there are, drop those in the chat. I'll keep that open right now because I want to transition here in just a minute to mortgage rates and talk about that with you. So we're about halfway through. We try to keep these to about half an hour. I don't want to overwhelm you, give you too much. I think I have about 15 total slides here, maybe 6 on the mortgage topic, and we'll wrap up. But let's talk about mortgage rates for just a minute. Again, if you have a question, you can drop those in there. What's happening with mortgage rates? I think that's the question right now. The last couple of weeks, we've seen a little bit of relief, and I'm going to talk about that. But I chose this image right here of this roller coaster, and I did it for a very specific reason, because I can for sure tell these people are upside down, but I can't tell if they're going up or they're going down. They're kind of in this maybe loop to loop. And I grew up in Atlanta, Georgia, and there was a theme park there, Six Flags, and many other places as well. And they had looping roller coasters. I would never go on them because I thought I'd get sick. And if you've ever been in a situation like that, it leaves you feeling with this, sort of pain in your stomach if you're not careful. And I think there are a lot of people, maybe in our business, folks thinking about buying homes that feel that way right now about interest rates. The average mortgage payment in this country this year has gone up almost $1,000. And even though we've seen a little bit of a relief in that, it's happened very, very quickly. Two things that are true about this. It's been the fastest rise in interest rates this year that we've seen in the last 50 years. Second thing, we've never been in a year where interest rates have doubled inside the year. That's happened this year. And so all of this is sort of kind of leaving us, what is actually happening? So here's my goal. I want to break this down to you, what's happening right now, so that you can be the most knowledgeable agent in your market on this topic. Now, I'm not suggesting what I'm going to say that you want to go do a client presentation on this. I want you to have the confidence that you understand what's going on so that you can competently lead your clients. Okay, so I'm going to hop in here and run you through a few slides, then we'll kind of pause and open it back up for questions. I'll bring Shaniqua back up and we'll do that. But first quote here from Lawrence Yun, chief economist at NAR. I think we all probably know he is. A return to a normal spread, I'll come back to that, between the government borrowing rate and the home borrower or the home purchase borrowing rate will bring the 30-year mortgage rate down to around 6%. What's he talking about right there? He's talking about the government borrowing rate being the 10-year treasury, home purchase borrowing rates, the average 30-year fixed. So he's talking about the spread between the 10-year treasury and the average 30-year fixed mortgage. If you followed Keeping Current Matters, you know that if you want to know where mortgage rates are going, watch the 10-year treasury. That's exactly what he's talking about. And so let me break this down. If I were to give you a visual right now that, a picture for this, these words here, it would be this right here. For for the past 50 years, the 30-year mortgage rates moved in unison with the 10-year Treasury yield. We've talked a lot about this on this call with LabCoatAgents, just about this topic. The average spread between the 10-year Treasury and the 30-year fix has been 1.7%, or, if you're in the mortgage business, 170 basis points. So literally, if you took the Treasury yield, you added 1.7% to it, you would be in the neighborhood of the 30-year fixed mortgage. And that's going to, go up and down. They've had almost this symbiotic relationship for the last 50 years. So you want to know where mortgage rates are going? Start to watch the 10-year Treasury. Now, what's interesting? What's happened in the last couple of weeks with the 10-year Treasury? We've seen it fall. Why has it fallen? Well, we've gotten a couple of hints, I'll call it, that we may have some good news on inflation. And that good news, truthfully, has been things aren't as bad as we thought they were going to be. What's come out as inflation measures hasn't been as high as we thought it would be. Now, I'm not here today to suggest that we're out of the woods. I'm saying we've got a glimpse of what could be coming in the future. We want it to be true. We want it to hold up, and we want them to continue to give us good information. The mortgage market's looking for good information relative to inflation, because inflation is the enemy of long-term interest rates. As long as inflation's high, mortgage rates are always going to be high. So let me break this down and give you a little bit of a perspective that our team has built that I think will really help you understanding what's to come in the next year relative to interest rates. So first one, this slide right here, why are mortgage rates not at 5.5%? So let me kind of break this down. This has to do with the 10-year Treasury and the spread between the two. So first box here, if you were to take the average of the 10-year Treasury from 2000 to 2021, the last 20 years, we'll call it, average 10-year on the Treasury yield, 3.49%. The average spread, 1.79, making that mortgage rate 5.28. Okay, so that, go back to the last 20 years, average 10-year Treasury, average spread, that's where we end up. Well, where are we at today? Let's go to the next box in the middle there. Today, in some of these, the mortgage rates actually fallen down below 7% right now. So, just keeping in mind, these are changing every day, but the 10-year Treasury yield, 3.73%, the spread, 3.35, giving us a mortgage rate of just over 7%. So what you see there is you see a Treasury a little bit higher, but the spread dramatically higher. Now, if I go back to what Lawrence Yun said, he said a return to a normal spread. If we were in a scenario right now in the mortgage business where we were in a normal spread, and I'm going to call that normal 1.79%, like we've seen for the last 20 years. And oh, by the way, the last 50 years, it's been 1.7%. We'd be about 5.5% on the 30-year fixed. So the question you want to ask yourself is, why is that spread lengthened? And I'm not suggesting we need to get into this conversation with people that are thinking about buying. If they're interested in it, certainly you can. But the simple answer for that is mortgage pricing is up because of volatility and because servicers know all of these loans are going to be refinanced. Think about that. Anybody that buys right now in a higher interest rate environment, what are they being told? Hey, as soon as rates come down, you can just refinance. Banks know that. And so they're charging a premium for these mortgages right now. That's the most simplistic way to understand that, explain that. As better, continuing information on inflation comes out, we can expect two things. So you see a little bit of relief in the 10-year Treasury and see a lot of relief in the spread. The only question is time. Is it 6 days? Is it 6 weeks? Is it 6 months? I know it's not 6 years. I can guarantee you that. But I think as we go into next year, we should expect that. We should expect more, good news on inflation. Again, I want to position it how I said before. I don't think we're out of the woods. I don't think we should say the last 2 weeks are the determiner of where we're at in inflation in this country, but we should be expecting this to happen. I think we'll hit a spring market where we should expect some relief to come along. And I think you'll see a lot of demand relatively for housing come into the play, because we've seen a lot of demand taken off the table, the better part of this year. And so we're going to stay on top of that. We're going to continue to bring that to you. But I want to give you 3 perspectives from experts about the mortgage business right now that I think are very, very important to understand and maybe position even your relevant market opinion around. First one comes from Ali Wolf, chief economist at Zonda. Says the housing market is expected to face continued uncertainty heading into 2023. Truest statement ever, right there. Continue to expect uncertainty. It's going to be a volatile market as consumers, financial markets, and policymakers work through their respective challenges in today's economy. We're not out of the woods yet. That's what Ali's saying, essentially. Okay, so expect it to be volatile, up, down, up, down, up, down, as we go through the next few weeks. Barry Habib from MBS Highway. Because we see a slowdown and we see the inflation comparisons start to become more and more favorable, you'll start to see that inflation number move lower, lower, lower. And as a result, mortgage rates should move similarly on a downward trajectory, probably giving us around 5 or maybe even below 5 over the next 6 months. So go back to what we just talked about in that graphic, where we say 5.5 is that target range. And Barry from MBS Highway, Mortgage-Backed Security Highway is what that is. Very, very knowledgeable, probably one of the foremost experts on the secondary mortgage market in this country, is saying exactly that. What is it out? It's all about inflation. You tell me what's going to happen with inflation, I can tell you what's going to happen in the mortgage market. Now, there are other things bearing down on it. I don't want to ignore those. They're, you know, the conflict in the Ukraine. There's other things that bear into it, but inflation is the large driver of this right now. I'll end on this. Bill McBride. My current view is inflation will ease quicker than the Fed currently expects. That's Bill's perspective. You know, he runs a calculated risk blog, expert that we follow, very, very knowledgeable in this topic. And my hope is, I want to pull these slides down for just a second, and Shaniqua, bring you up in just a second, is that this information, whether it be about debt, whether it be about interest rates, gives you the confidence to help educate those you're working with. Because a lot of people right now are wondering, should I even buy a home? Is this a good time? Is the market about to crash? Are we going to, you know, end up in a situation like 2008? And I think our job is certainly to be educated. So I want to pause there, bring you back up, Shaniqua, and grateful for the time just to share with everybody and talk about these topics. I think you're on mute.
We appreciate you being here, and I think that the conversation that we're having today is really about the timing of the market. How do we time the market for the benefit of our clients? And these are conversations that we're having every day. I know if I go to a wedding, I'm having a conversation about the timing of the market. If I'm going to the grocery store, I'm having a conversation about the timing of the market, because this is the news of the day when it comes to a financial instrument that's tied to generational wealth. Or just housing in general, which is a very important topic. So I'm glad that we were able to clear the hurdles on that today. So Jay, I want to open it up to any Q&A that we may have. Do we have anybody that is asking any questions in LabCoatAgents world, in the Facebook group, or in the chat? Nothing so far? Okay. Well, the one thing I will say is and maybe this is a good question, is I understand that the feds are meeting again on December 14th.
Sure.
And I know that you had a slide that said that there's an expected cure of inflation sooner than the feds expect. Sure. Do you think that they're going to give us another rate hike, or should we expect another bumpy ride of them landing the plane a little bit inconsistent going into 2023? What is your expectation going into the next Fed meeting? Well,
I certainly think in let's not talk about my perspective for a second, because I'll tell you what people that really understand this, what their perspective is the Fed's going to raise rates in December. That's their perspective. And that's pretty much the consensus of the market. Now, the Fed does not control mortgage rates. That's the important thing that everybody has to remember. I think we have to get out in front of that. But the Fed's action is all about taming inflation. So what you're actually looking for is you're actually looking for the Fed to signal that we're going to raise rates, but we may be at the end of raising rates. So there'll be a couple of cycles that'll happen at this point. So they will start to raise rates at a slower pace, and then they'll get after that to a point of neutral, which means they're not doing anything. So that'll be the first step. Second step is neutral, and then the third step is they would then begin cutting rates. And so that's what you want to look for, where are we at in that cycle. But again, this is all going to be about inflation. You know, if you go back to Barry's projection, as you see more and more good news about inflation coming out, which again is going to be, the Fed's going to watch that, you should expect interest rates to come down. So, you know, if I were talking to somebody, actually our team is writing a blog on that, and the bottom line would be interest rates are going to come down. It's just a matter of time. We can see it in the technical signals, and we can see what's happening there. So that would be my perspective. And I want to address one other thing. I think the question right now is dealing with the person or answering the question, should I buy a home? Or number two, I'll just wait until interest rates come down. Right? I mean, that's what, if I was somebody, I don't think that's illogical if we're not in the business. For the person, because I would use this information to talk about buying with somebody who's waiting for interest rates to come down. My question for the person that's waiting for interest rates to come down in this market would be this: what do you think everybody else is doing? What do you think they're going to do? As soon as we see interest rates, and I'm going to say fall into you know, this range of 5%, even 5 3/4, just psychologically for people. There are a lot of people that put off buying a home this year because they shot up. You're going to see a lot of demand come back in the market. And so if you truly do believe it, I would buy now and I would refinance them, if that makes sense. And obviously they've got to be able to afford it. But I do think that is the question that we deal with on a daily basis.
Oh, absolutely. I mean, I think when we started seeing the uptick, that certainly was alarming for the public, and the media did not help. And this is why we have these conversations here, and this is why it's so important that we have them from industry professionals like yourself, so that we can really get through the mud and get to the other side.
Yep.
And really come from a place of data and fact and not opinion.
Right. There are a lot of opinions in our business. There's no
It's a lot of opinions in our business, a ton of opinions in our business.
Yeah.
But at the end of the day, all of us are in the same industry, and people look to us for that gleaming hope of where's the pot of gold. And if we can kind of give them a inclination of where it's going to land, you know, that's better for all of us as professionals, for sure.
Absolutely.
Well, I think that we're going to wrap this up, because I don't think that we have any questions in the chat or in Facebook world. Is that true, Jake? Still no questions?
None yet.
Everybody must be on lunch break or starting to get their second round of coffee, and that's absolutely fine. No judgment for me whatsoever. But I would like to thank you, David, for joining us today and giving us all this great information. I think it's, again, timely information. And everybody can find you where? I mean, not like they don't know where to find you, but just
Absolutely.
in case.
Go to keepingcurrentmatters.com, start a 14-day free trial. Would love to have you as a member. And I think it's critical in this market to understand, kind of to your point, Shaniqua, being able to respond to what people are asking and so what the headlines are saying is our job right now.
Awesome. So again, thank you all for joining us. Make sure that you subscribe to our YouTube page. I saw that in the chat, so I want to make sure I reiterate that here. And welcome to another edition of a Lab Coat Agent webinar, where we're exploring the science of real estate. My name is Shaniqua Badger. I'm a moderator, and I am going to sign off. Hi, everyone.